The dynamic reward to risk ratio is maybe one of the most important figures when it comes to understanding why you're not making more money, where you're leaving money on the table, how is trading psychology impacting your trading performance, and how is the reward to risk ratio dynamic changing during the duration of your trade, and how to deal with that. Hello, I haven't done those videos in a while, so let's get back to it. I have a lot of topics that I want to cover with you, and the reward to risk ratio and the dynamic reward to risk ratio is something that is often overlooked. So first step, what is the reward to risk ratio? Obviously it measures the distance between your entry, your stop loss and your target, and it puts it into a ratio as the name suggests. So it tells you the ratio between potential reward and the risk. So let's assume for whatever reason we want to go short here. We have our stop loss here, and this is just an example, obviously. And let's say our reward to risk ratio is, let me move it, is around, let's say 4, okay? Which is a good number. Can I get it? Yes. So this is a 4-to-1 reward to risk ratio. In TradingView, you can see it right there. Here it says reward to risk ratio. And what does it mean now? It's much more than 4-to-1 is nice, 3-to-1 is good, 2-to-1 is too small. That's what most traders just throw around. But what does it actually say when we look at the numbers? And trading is all about numbers, expectancy. It's not as complicated as it may seem. So let me just write it down for you. So 4-to-1 reward to risk ratio. What does it mean? Your one winner equals 4 losing trades. That's very important to understand. So obviously the reward here is 4 times the size of this of your risk, obviously. So what for one winning trade, or if you have 4 losing trades, you only need 1 winning trade to offset the losses. And this means out of 5 trades, okay, it's too early to write correct English, out of 5 trades, you need 1 winner to break even. All right, what does that mean? So it means that 1 out of 5 trades need to win, and what is that? 20%. So, and this is not as complicated as it may sound at the first glance. It means that you need a win rate of 20% or higher to break even. And that's a very important insight to have here. And this shows you the power of choosing a reasonable reward to risk ratio. And obviously there are a few implications here of the reward to risk ratio size. Generally speaking, what it means is that the higher your reward to risk ratio, obviously the longer you will usually stay in a trade, and that means that the higher your reward to risk ratio, the lower your win rate is. So what you see with trading systems often is that if you have a high reward to risk ratio, then they have a very low or a lower win rate compared to a system with a relatively small reward to risk ratio. Then usually the price has an easier time reaching your take profit, and then your win rate will go up. So it's a balancing act, and you need to ask yourself, okay, what type of trader do I want to be? I don't mind having a low win rate. Then you can go for a higher reward to risk ratio. 1 winning trade will then offset a few losing trades more or less easily. If, that's a big if you can stay in your trade and not cut your winning trades too early. Because, well, what happens often is that traders say, okay, I have a system with a 4-to-1, maybe 5-to-1 reward to risk ratio, and that's great because a high reward to risk ratio is super easy to trade. Your winners are very big. But if you then cut your winning trades too short, while you always let your losers get into the stop loss, then you're messing up the whole dynamic of your reward to risk ratio. All right, that's just a little excursus, but that's not the point of this video. The point for the first point was just to give you an idea of what does it mean if you trade with a 4-to-1 reward to risk ratio, and how does it transfer into your win rate. So, but what happens with the dynamic reward to risk ratio? So let's say the price moves a little bit further and the next candle looks like this. How does it change now? Because suddenly, if you're not doing anything, the current price is obviously here, and then how much you can lose has increased significantly, whereas what you can gain in addition to what you already have has decreased significantly. So if we now measure the reward to risk ratio, and that's the dynamic reward to risk ratio, the stop loss, let's say it's still at the same place, the target is also still at the same place, and you can see now it's 0.9. So let's, for the sake of this argument and for the sake of math, let's say we have a 1-to-1 reward to risk ratio. So 1 winner equals 1 loser. That's a very, very different outlook, obviously. So out of 2 trades, you need 1 winner to break even. So 1 out of 2 equals, you guessed it, 50%. And now you need a 50% win rate to break even. So you can see this is a very, very, very different outlook now, and this is how the reward to risk ratio changes during the duration of your trade. And obviously trading with a 20% required win rate and a 50% is a huge, huge difference. It's more than double, obviously, 2.5 times to be exact. So this is something that you really need to understand, because at this point now, when you're in a trade, now you're faced with a decision. What are you going to do? Because you suddenly realize, oh wow, I have so many unrealized profits. What am I going to do with that? Because the market could turn around and then it eats up all your profits and you're left with nothing. And then what many traders do, as you probably have seen from experience, is that you cut your winning trades too early. But what does it mean now? It means that you were shooting for a 4-to-1 reward to risk ratio, and let's look at what it is now. Now it's 1.6, so you have more than halved your initial expectation of your trade, and that is very, very, very dangerous, because if you think that, let's say you enter with a 1% reward position size and you expect 4-to-1 reward to risk ratio, that means a 4% gain on your trade. But if you cut it at 1.6, where we are right now, you will only get a 1.6% outcome of your trade, a return. And that is not even half of what you expected in the beginning. And if you believe in the get-go that you have very high reward to risk ratio system and you don't need a high win rate, but then you mismanage your trades in such a way that completely destroys and messes up your reward to risk ratio and your expectancy, suddenly you have turned around the whole dynamic of your system, and whereas you have believed that you trade a high reward to risk ratio system, you are actually not. And this is so important, because you need to really understand that you need to track your initial reward to risk ratio, obviously, very, very important, and you need to compare it with the reward to risk ratio that you have once you finally close your trade, because that will only tell you, okay, what's the actual outcome of my trades, and then you can compare expectations with the reality, and you can see, okay, how do they compare to each other, and how do they compare to each other, and then you can make better decisions, and you will actually finally understand what your trading system is all about. So what you have now, what is your option now? Obviously, you can do something here. What many traders do is obviously cutting your trade ahead of the take profit. Not that great of an idea, because as I said, you reduce the expectancy. What you can do is that you can trail your stop loss. Let's say, so first of all, so first your stop loss was here, and then your entry was here. So what many traders do is that they just trail their stop loss to break even, or they say, oh, I want to at least have a little bit of profit guaranteed, so I will move my stop loss beyond break even. Well, okay, so let's first take a look at, now you have a 1.65. This means that compared to what it was previously, 0.9 or something, you have almost doubled your reward to risk ratio, which is good, obviously. So reducing or trailing your stop loss can improve your reward to risk ratio, because now the potential loss is smaller, whereas the potential gain is still the same, but just as long as you can manipulate one part of the equation, it will change your reward to risk ratio. But what happens, and in this example it's not that clear, but if you trail your stop loss too soon and too close to the price action, what often happens is that you will suffocate your trade, and such traders, they will often see that the market is going back beyond their beyond their stop loss, and then it goes in your favor. How often have you experienced something like this? I'm sure many of you can relate to that. That you say, oh, my stop loss, my trade idea was good, but then the market turned around, took my stop, and then went to my target. This is what happens when you move a stop loss to break even too soon, too close. This is why I'm not a big fan of break-even stops. Another very, very bad idea, or well, it doesn't make any sense because the traders then say, okay, I move my stop loss to break even because I want to have a risk-free trade. But is it really risk-free at this point? If you move your stop loss to break even, of course, the trade cannot go into negative most of the time. There's still a chance that the stop won't be guaranteed, but well, let's say in most of the cases your stop loss will be taken out and you're left with a zero outcome trade. But was this really risk-free? First of all, no, because at the beginning you risk something. The trade could have gone into negative. So over the long term, if you do that, it will pretty much destroy your expectancy. Second of all, once you move your stop loss to break even, you still can lose the unrealized profits. This is something that many traders overlook. And that's a real risk, obviously, because obviously you haven't really locked in the profits yet, but they are still somehow part of the trade that you are engaging in. And you cannot say that you are not risking anything. You are obviously always risking something. You're risking that the unrealized profits will turn around. You're risking that you will not be able to capture the whole trade, the whole take profit when you're taken out too soon. So there's always a risk in trading, and you can never fully eliminate risk in trading. So please stop thinking about risk-free trades once you have a break-even stop loss. That's very, very bad. So trading stops can be a good idea, but only if it's done with a plan and if you're not suffocating your trade. What I usually tell my students, I'm not a very big fan of break-even stops, but if they need to trail their stop loss because it makes them feel better, make it very, very slowly, very slowly. Give your trade time to breathe, and also very important, track it. Track in your trading journal how the trade management decisions is impacting you. And if you're using Edgewonk, which I hope you all are, then you really need to understand. Well, then it's very easy that you can understand your trade management. You just put in your figures and then it will show you exactly how is your trade management impacting your trading performance. And then you can see it in front of you. And I've seen it for many traders that trade management decisions are often done with good intentions in the beginning, but traders just mess it up because, well, as soon as we are in a trade, the emotions take over, we look at our P&L, and then all the good intentions go out the window, obviously. So trade management is very, very tricky, and I have seen for myself that a passive set and forget approach is much better. My trading system usually has a reward to risk ratio of around 3:1, so I only need a win rate of around 25% to break even, which is doable quite without too much effort. And then I don't need to mess around with our trades. If I believe in my trade hypotheses, if I see, okay, I'm entering with the market, with good momentum, the pattern is there, I've done everything that I should have done, then I just let the market take over and do the rest. I'm entering, I put my stop, my target, and then I will see, is the market agreeing with my trading idea or not? And then, yeah, you will see it. And more importantly, you need to always compare your trading journal with what has happened. So there's no excuse why you should not track it, and it's so easy to do nowadays. You don't need an Edgewonk necessarily. This is not going to be a plug, but just go through your past trades and see how is your trade management really behaving, how is it really performing for you, what could have you done better, what should you have done better without the benefit of hindsight. And then you will learn to use the reward to risk ratio in a better way and make better trade management decisions.